The current outlook for commodity market is very positive. Fundamentally, the demand for commodities come from economic growth. And if you look at the major consumers, US, number one economy, we've seen unemployment drop, we've seen export being strong, and consumer continue to spend, and that is very positive. In China, we've seen inflation come down, and housing market stabilizing, and the government started to loosen their lending policy to encourage economic growth. And in Europe, there has been some turmoils and there has been a mild economic recession, but they have rescue packages in place for various countries, and the central bank has really provided liquidity for the banks. So overall, demand continues to be very strong, and outlook is very positive. Commodities themselves have performed strongly over the last 12 months. However, resource stocks have not in most cases. In some cases, they even come down, even though commodities went up. The biggest reason for that were the macro headlines that coming from, negative headlines that come from various regions. For example, European financial crisis, potential breakup of European Union, and in the US, the political stalemate between the White House and the Congress, and China, real estate bubbles, and potential for hard landing. As I mentioned earlier, the situation on the ground really is much better than the headline suggests. The short answer is they will. As global economy pick up steam, especially in the second half of 2012, commodity price will continue to be strong. Confidence will return to the market, and you will see money flow coming back to some of the area that's been neglected. Resource stock, especially junior resource stock, and the performance of stocks will be more in line with underlying commodities, much as they have been historically. The two most important features of this fund is one, it has guaranteed short duration, 12-month liquidity versus the traditional 18 to 24 month. What that does do is give investors choice in terms of getting extra tax deduction or stay with the liquid mutual fund or go to cash, which is very powerful. The second thing that's different is that we very much focus on lowering the risk in the portfolio in order to preserve investors' capital. I manage risk by diversifying and actively managing the portfolio. Diversification starts with diversification by commodities. The portfolio will have exposure to oil, natural gas, uranium, as well as to gold, base metal, and coking coal and iron, and so on. The other thing we do is to invest in different type of companies. Some will be earlier stage, higher risk, but higher reward, junior exploration companies. The other kind would be more mature, cash flow positive producing company that gives more stability and more liquidity. Combined, this should lower the risk profile for the portfolio. Once the 4-month hold period is up, we will actively manage the portfolio to adjust it to the new investment environment. Specifically, the mix about 50-50 between energy and mining. On the energy side, we have about 25% oil, 10% natural gas, and 15% uranium. On the mining side, 25% gold, 15% base metal, and 10% bulk material, which means coking coal and iron ore. As you can see, we particularly favor oil and gold. As global economy continue to grow and commodity prices staying at very high level, resource companies are enjoying very strong profitabilities as well as strong growth opportunities. As stocks catch up to where commodities are, investors will enjoy strong return over the next 12 months. This is the time to invest.